Last one in the Affirm series. This is it. This is the final one. The last and final one. How's the sound? Does it sound like I'm yelling into the mic? Is the stream clear? I can't get it pulled up. It's not loading. Oh, there we go. Okay. All right. Last one in the Affirm series. Finished the report. Got my MBA mug. Shout out Kaylee. I don't think she'll ever watch this, but shout out to her. Savoca, I love you. Thanks for joining. Thank you, Savoca. This is the final report. This is everything that we've been working towards. So I hope that you find something that you like and you see and you take back to your LPs or some whatever, you know. This actually is. Let's take a quick look. Let's take Affirm stock. Let's see where they are the last 10 days. This is in no way is how we invest, but we're going to take a month. I'd say I started this in about the middle of October. So they were about $40 in the middle of October, maybe 41. And they're now at $50. Now, a lot of that probably has to do with Trump being elected. We know equities went up a lot, but you know, it's still exciting to see. Coinbase was another one that we did. If anyone ever wants to go to Pear does narrative analyses, there's Coinbase, there's Amcor. A lot of these stocks are technology stocks, Block. A lot of them are payment related as well. Something that I'm super passionate about. But you know, just trying to spread the word, trying to want to share with people what I do on my free time or what I do with it, so that everyone else can see what's out there, not have to do it themselves, just kind of tag along, a little co-working experience. So, it'll be fun. As I said in the last stream, I think we'll pivot from stocks into something more applicable with payments. I think we'll go back into crypto. Chainlink has recently done a test with, I'm blanking, Swift. And that is huge for our financial system, not just as an investment, but I just think as a whole, the financial system being able to communicate with one another, it's massive. So let me know if it sounds like I'm yelling into the mic or the stream's not buffering, but doing the best we can here, and we'll get right into it. So for everyone who's been tagging along, who knows what we've been researching here, this is Affirm. Affirm is a payments company that does a lot of short-term consumer loans. So if you go just like we did, we recently bought a couch. In that case, for your more, let's say, heavy debt requirements, so a couple thousand instead of $100 or maybe even $500 at the grocery store, you have other companies. You have Synchrony, you have Klarna, which is a little bit more in the Affirm range, but Affirm also had the option for us to buy. So that's just a personal example of me using these types of companies in our personal lives, right? So I don't think these companies are going anywhere. And as you'll see, this is something that's just going to pick up more as consumer debt becomes a large standing issue, as well as rising prices of goods. It doesn't matter political views or not. I think that's just a common in the world with inflation, with tariffs, with war, with anything, right? The price of goods is going to go up over time. The governments can try to put a ceiling on the prices of goods, but in a free market economy, those goods are going to come to a middle ground themselves. And if there is a reduction in the production of those goods, those prices will go up. So, diving in, what is Affirm, right? I'm not going to read it all to you guys. This will be put out there if you want to go through it. But Affirm is a buy now, pay later company. A buy now, pay later company is a short-term financing company that allows people to take their purchases and spread it over a long period of time. So typically there is no interest involved, and that is true, but oftentimes this can be misconstrued with there is no annual percentage rate, right? That APR is not tacked on to the life of the loan. So it's not like, hey, here's your $100 loan, I'm going to charge you 20% interest. What actually happens is that APR gets baked into the principal of the loan itself. So instead of taking out a $100 loan and paying 20% interest, you're just going to take out a $120 loan. That is a workaround that these companies have realized people don't catch on to pretty fast. We'll see later on that Affirm has different products that they have where this isn't the case, but just to provide you another example, we went mattress shopping. If you go to the mattress store and you see they have two options, I just hit my desk. They have two options that are stapled to the bed, right? They have one option, which is your buy now price. And then they have a 32 easy payments of $35, okay? More times than not, people are not going to do what is 32 times 32 or whatever the price of the mattress is. 9 times out of 10, that price is going to be more than the spot purchase price. You are going to pay more if you take the $30 monthly payment than if you pay up front. Still, this may be a good option for some families, some people, if they can't afford a balloon price up front or that initial price to purchase the object. Excuse me, but it does allow them to purchase the good. It is also something that most companies do not advertise unless it's something that they know that is going to bring you in. That they do have options where you can purchase the good. Let's say in Affirm's case, pay in 4, you have every other week you will pay in 4 payments to purchase that item. So let's say you have a $500 good, you will pay $150 or whatever that math is, 170 something or whatever the math is, every 2 weeks, so that you're not paying that up front, but that is still something that you are paying. No hidden costs, no interest. There is no interest for late payments. Sometimes there are extra or additional payments at the end of the loan if you have not completed the loan by the end date. So if you have to have it in by, let's say, December and you don't pay it off by then, there might be additional interest at the end of the loan. But if you have, let's say, a payment at the beginning of December and you miss that payment, they are not going to charge you interest because your loan is still active. So Affirm is founded by Max Levchin, who is one of the founders of PayPal. And PayPal is one of the largest companies in the world regarding payments. They own Venmo, they own PayPal Commerce. I believe they bought eBay or the other way around. So they have been around a while. And that is something that really stood out to me when researching this company, is that Max Levchin not only founded this company and founded PayPal, so there is a huge crossover, and he is a serial founder who knows how to work in the payment industry, who has those connections. But as we'll see later on in the key people, this is a stacked team. Like this team is stacked to succeed, and they have these partnerships that I think will play heavily to their favor. So Affirm's loans are offered both to consumers and to businesses, right? So our initial example was that these loans are to you and I to go purchase goods, but they're also to businesses so that they can finance their business, so that they themselves can buy goods. And there's a wide variety of products that they offer to both consumers and merchants. If you're a merchant, you can also take what Affirm offers and offer it to your consumers, so you are on the Affirm payment rail. You'll see here that they offer the online checkout payment options, but we'll go down to the products, and you'll really see how game-changing these products are for consumers and merchants. So as of 2024, Affirm reported nearly 18.7 million users, and this is indicated by users that have at least one payment on their platform in the last 12 months, processing over 26 billion payments annually. That doesn't mean that that's what they're getting, but think about what you buy and how your purchasing works when you go to, let's say, a Macy's or even Publix or Walmart, wherever you are. They are getting a percentage of the fee on the network as well. If you're a business, one of the reasons that you would accept to use Affirm is it allows your customers to buy goods from you, right? So let's say I was going to buy a mattress and I couldn't afford the mattress up front, but I decided I wanted to use Affirm. The mattress company is now getting that money that they would have never otherwise have gotten because I couldn't afford it myself. But now taking a line of credit out with Affirm completely revolutionizes that, because now the consumer gets their product, the merchant gets their cash, and they are willing to pay a little fee on top of that so that they can get everything they need to keep their business running. And at the bottom here, I have a little, I keep notes so that you can see what's the difference between what is the truth, what's actually something that was found in the research, and then something with my own little twist at the end. So yes, he is that boy. He is a part of the PayPal mafia, but what a lot of people don't know is that he created CAPTCHA. And what CAPTCHA is if you ever, go to a website and they're like, hey, tell me all the squares where there's a motorcycle, or which square is a cat. That is something that's really revolutionized the online sphere or the online world, which again really is a testament to how well Max is ingrained in the space and how he's really revolutionized the web, in my opinion, and will continue to do so, which is something that is really to his favor. But fun fact, if you didn't know, a lot of companies, let's say AI, for example, will use the results from CAPTCHA because it's a great way to train your models on what's true or what's not true. Now, it doesn't mean if it's asking you what a cat is and you select what a dog is, they're going to take that and say, hey, AI model, go train on this. And then that model now thinks that a cat is a dog. It's going to take, let's say, thousands, hundreds of thousands of clicks from different people who have looked at that same CAPTCHA and deduce which square, let's say it's a 90% threshold, was clicked on 90% of the time. They then take that and say, hey, this is a cat. So now these AI models or these systems or whatever they're doing with that data now is able to, discern between a cat and a dog, which is really cool. It's free, not for the businesses, but for them to gather that data, right? Hey, do this before you enter this site so we can tell that you're human. Most oftentimes than not, they won't even say no. They'll just let you go through. But it's something cool to know, and that's something that he had a part of. And then at the bottom here, something that we just talked about with the increased cost of living, reduction in affordability of goods, and the stagnation, let's just even say the wage gap. Whatever's going on in the world, I think in Western countries, you also have this high consumerism that will cause a lot of people to take out their short-term consumer credit so that they can afford their lifestyle and lifestyle creep, which will only promote these companies further. I do want to caveat that yes, it seems predatory in some sense, right? You're betting on people not being able to afford their current lifestyle or their lives. And that is true to some degree, but it's also the same with, Visa and MasterCard and any bank really, right? Those payment processors or those payment systems or the banks are a little bit more convoluted. They have a lot more products, but they really generate revenue based on late fees, right? You're not being able to pay your credit card debt, or hey, you seem to use a lot of credit, we're going to offer you a larger credit line, and so we hope that you go spend more, and therefore we make more money. So it really is the different sides of the same coin, and you'll come to see that this is actually the natural progression of the industry, and it's really revolutionary with the technology that we have these days, that we're able to do this and that they're able to do this. So key people, something that is really important with any company, especially one that is just as new as Affirm. I believe they started in 2012. Again, Max founded PayPal. They did acquire eBay. Okay. They are the top payment processor in the world with 45% of the global pay market. And this is something that is very important, something that I want to harp on, that PayPal is one of the largest competitors to Affirm. I think most banks and even payment processors are beginning to offer buy now, pay later, because they realize that it's such a large need for these companies to be able to subsidize their customer spending. So it does help that Max has an in, that he knows these people, he knows how the business operates. He built it from the ground up. He acquired it or he helped merge with X. Fun fact, if you didn't know that, Elon Musk owned the domain X before Twitter, right? This is all the way back to PayPal days. X was something that he always wanted to own. So don't be shocked when Twitter, formerly Twitter, now X, becomes some sort of domain for all, right? They already have, what's their AI? It's not Claude, but they have some other AI. It was really a way for him to put everything in one place, and that's how he had that domain. Max also has an innovation lab, a startup incubator called HVF, Hard Valuable Fun, that he used to help create other companies that are very, very famous. Yelp, Divvy, and other companies such as Slide that have been acquired by larger companies such as Google. So again, when your company gets acquired, you then typically go work for that company to keep the wheels moving until you're able to step down as a part of your vesting period. And Max has spent some time at Google, so he has an in to all these large enterprises and knows how they operate and knows how to network, really, to really lament himself as one of the forefathers of Silicon Valley. Now, take that with a grain of salt. Silicon Valley was way before PayPal, but you've heard of the PayPal Mafia and what everyone is doing today. I highly suggest you go look them up. They created YouTube, now with Google, LinkedIn, I think, as you see there, Yelp. There's just so many that came off of the guys that helped found PayPal. So that's super, super important here, because he is a serial entrepreneur who has invested and started over 100 startups. Moving down, we now have Libor. I don't want to try and butcher a lot of these guys' names. Libor Mikhailik, president and director of the board, who was the former chief technology officer, CTO of Affirm, and he previously held the engineering director positions at YouTube, which is now Google, and Google. So he moved from the business unit to Google, where he was responsible for application infrastructure and site reliability. Now, this is super important as well, because Libor spent a lot of time building up Slide with Max. So they have a long-standing working relationship, and they go back very far. And so this is something that I want to point out that is really, really important, not only to Affirm as a first mover in the buy now, pay later space, which is super important for them attracting customers, but during his tenure at YouTube, he tripled the number of page views in hours of videos watched and the revenue. So he was able to drive traffic to this video site, which now YouTube is now synonymous with any long form video. I don't know any other place that people would go to watch videos. I think kids even now today use it to watch their shows. But any user generated content, YouTube is the first to everyone's mind, and Libor really helped grow YouTube to what it is today. So super important for Affirm, and I want you to keep that in mind as we go through here, that they have two of the leading people for the web, basically, right? There is no web today as we know it without YouTube. Now, hindsight's 2020. If YouTube didn't exist, I'm sure there would be another company that would take its place. But as it stands today, that's what happens. Moving down, their CRO is a former president and CEO of PayBright. Now, PayBright was, I don't know if they still operate under the name. I don't think they do because Affirm is larger, but he founded PayBright, which was Canada's largest buy now, pay later firm, which was then acquired by Affirm. And he previously held the international arm for Affirm. My guess, I couldn't really find much about it, was because Canada is international with regards to the US. So doesn't necessarily mean they were going over to, England, France, Japan. I'm sure they're trying, but in industries such as this, it's very hard to break into new countries and new markets. I think I heard that Revolut is the one who's been able to do that the most, the French company. But even then, I think they've only broken into 8 substantially. I'm sure there are others, but really like having a large chunk of the market share in these countries. So Wayne, huge asset to have. And with that acquisition, right, you have the largest buy now, pay later in Canada, and now the largest in America. We're just going to say pure play, right? Because you could throw PayPal, you could throw some banks in there, but pure play, buy now, pay later, Affirm and PayBright. This is a match that's going to go 11 rounds with them together, right? It might be a knockout in the first, but they're ready to go to the last round. And then lastly, one who stood out the most was Vishal, who is their senior vice president of product. Now, yes, your CFOs, yes, your head of marketing, whatever it is, those are all important positions to have. But I think when you are a product-oriented firm, which they're a tech product-focused enterprise, your leader of product is one of the most important people that you can have, right? They're the one that is building everything that the user is using and the user experience. So he is responsible for product management, product design, user experience, and the marketing of the product. So the end-to-end lifecycle of the product. And he joined over 4 years ago and has really scaled the Affirm card, which you'll see later on is a super important product that they have. And he has prior roles at Microsoft. So again, going back to the whole networking aspect of the career, getting the ins, getting the outs. He worked with Windows, Xbox, and Azure, which when you have a payment company like this that is processing millions and millions of payments every month, every year, it's super important that you have connections in the processing space, in the storage space, in the online and general space. So it's super helpful that they have a team with experience at Google and Microsoft, two of the leading companies in that realm. So again, having a founder-led company is super ideal. Max and Libor have a long-standing relationship. And then lastly, they have a breadth of knowledge across the management team. Again, shout out to everyone else on the management team. I couldn't really fit all of them in here, but I highly suggest that you go check them out and learn more about them. So now hearing about what Affirm is and who the people that run Affirm are, I think the next, probably the most important part of this whole piece is to really understand where Affirm is coming from and how they even got this idea. So I put this graphic together, which I believe is super important to really understand the evolution of consumer credit in the US and America. But that would really, it's what really shaped my opinion on this company and why I think just buy now, pay laters in general are something to watch. That in the early 1900s, you had what were known as loan sharks. Typically, I don't know if you've seen Batman. I believe maybe Penguin was that his name. I think he was, lending money to people, and then if they didn't pay, like chopping their fingers off or something, right? So that was not uncommon back in the day. These were loan sharks that Hey, you want to put your kid in school, but you don't have the money. I'll lend you the money, but at a extortionary rate, 20%, 30%. And that is just, unheard of these days. They still exist. Your payday loans, if you ever take out a payday loan, I'm sure they charge a large amount of interest. A payday loan is just, getting money from someone early out of your paycheck, and then when you get your paycheck, it automatically pays these companies back. But so early 1900s, you had loan sharks, which were, again, individuals. The loans were typically in cash. Credit wasn't a huge thing back then. Even buying a house, right? Mortgages were, slowly coming into fruition. But the popularity of loan sharks grew as means for poor people to cover their costs. So you can imagine the Great Depression or any other part of the early U.S. situation where people would need loans to start businesses, to go to school, or even just to sustain their lifestyles. Moving forward 20, 30 years, you then have store and bank loans. This is something that is very, very popular today, although there is a little bit of a change where you can go to a store today and take out that loan. For the example, for furniture, right? Synchrony would loan that. But the big difference here is that let's just use City Furniture. City Furniture is not the one that's lending that money. They are using a third party, Synchrony, who is taking the risk of loaning us the money. The only thing that City has done is provide the furniture. They're getting the money back from Synchrony. So a little bit of a switch later on down the line, but to the point, 20s and 30s, you had stores and bank loans. So this is your mortgages, or if you're going to, again, furniture store, they would be the ones lending you the money to make those purchases, and then you would have those installment plans to pay back the loan to whoever loaned the money to you. 1958, huge pivotal moment in U.S. history. Something that if Drew or Michael are on this stream, they can also attest. This was something that we researched for our master's capstone, which was Visa, right? What was Visa's impact to the world? Does VisaNet, is it sustainable? Is it something that makes sense? And long story short, it does, but what really stood out, and it's really pivotal in the history of the U.S., is that the Bank AmeriCard was founded in 1958. Quick revisionist history is that the Bank AmeriCard was not the first credit card, but it was the first well-known credit card. You had smaller credit cards such as the diner's card to eat at restaurants and then pay with a line of credit, but this was the first institutionalized credit card that was formed via a consortium, or first it was, I believe, Bank of America, but then it's now a consortium of banks where they sent out these cards in the mail. Okay, imagine sending cards out in the mail today with active credit lines. That is a no-no, right? Someone gets a hold of that card, they can run up your credit, and you're on the hook for those dollars, right? So this was the first mainstream consumer credit product in the U.S. We're not counting mortgages. We're not counting store bank loans. We are talking federal, across the continental U.S. You could use this card anywhere to purchase any good where Visa was accepted. Now, as you go to a store, it is like almost like, who doesn't accept Visa? You may even see people with like Discovery, where you're like, oh, that stinks, they don't accept Discovery. Well, that's where Visa was when they first started, right? No one knew what this thing was. And then slowly they saw, hey, if we offer to accept Visa card for payments, we may not get the cash initially, but we know that Visa is going to settle the accounts at the end of the week and then give us the cash that we collected over that time frame. So again, it was a way to get consumers in the store purchasing goods and then receiving that cash later on. Now you have, callbacks. Hey, I didn't spend that, or fraud, or whatever it may be, defective product where they can reverse, or you have a return. But this, again, was a way for people to buy goods, extend a long-term credit line that had to be paid at the month. They didn't care what it was for. You just had to stay under your credit limit. If we fast forward 50 years, without even researching Affirm, I think the next logical progression of consumer credit would be, hey, I don't want a $10,000, $20,000, $30,000 line of credit. That's too, it offers too much. Anyone can run that up. It could get stolen. It's too tempting. It's too much money on the hook. And so the next logical progression would be like, hey, I only want to take out loans for what I need, right? For a credit card, for instance, you have to run your credit score. You have to submit documentation. Typically, you have to submit bank documentation. So if you don't have a bank, you can't partake. And so there's a lot of different factors. And so then this is where Affirm steps in, right? They're revolutionizing consumer credit, which seems to be the next logical progression in this line of consumer credit through the years, because they are now allowing consumers to purchase goods on credit for specific paid items, right? It's not, hey, just spend it in a month on one card. It's, oh, you go to Walmart, $150. Okay, you can take a loan for that. Oh, we see that you have a $150 loan out with us already. We're only going to give you 100 right now for these other goods that you want to buy, right? So it's real-time processing of credit scores, of likelihood to pay back, which again is a part of credit score, but it's an internal metric as well, because you can see how often they use Affirm and whatnot. And so it really allows Affirm to provide in a niche where typical credit cards fail, right? It's real-time loans in that instance, which just seems to be the next logical progression in the line of consumer credit. So while not entirely predatory in nature, Affirm does offer these short-term consumer credits to consumers, which may not otherwise have the ability to purchase, which we've talked about. They do offer installment plans. Again, we will go to that in the products. And there's other products that you'll see later on, which all really brings a story together. And so this really just helps consumers who are looking for a means to supplement their expenses with short-term loans. And they do have options where there is no interest, right? That is the one thing that I think people really take to heart, which they should, is that you don't want to take a loan out if it's going to be predatory. So good on you, Affirm, for offering products that even do that. Before diving even into the products, we need to understand what or how Affirm is reaching their customers. And I believe this really, really starts with their payment partnerships. The dates don't really account for much here. Like you can look at them and they do speak to, how much they've grown. But what really stands out are the names, right? Amazon, Walmart, Target, Apple, American Airlines, Best Buy, consumer goods. You can buy anything at these stores, but take a look at the last one that just happened this year in June. They allow customers to get loans via Apple Pay. So they do have their Affirm card now, which I'm sure you can also put in Apple Pay. But being a part of Apple Pay and real-time processing for short-term consumer loans allows people, even if they do not allow Affirm on the self-checkout. So like if you go to Walmart, you'll see you can pay with Affirm. Even if they don't have something like that baked into their system, you can still use the Affirm card to buy products in your Apple wallet, and you can use it to go anywhere, really. That is completely game changer, because guess what? You have normal credit cards in your Apple wallet. So as more and more of these big brands join the network, there's more and more appeal, right? You see the name everywhere. You see, oh, okay, it's in my phone. I can take it anywhere I want. I can use this anywhere. So the larger the brand, the more potential that Affirm has to bring on customers. So even outside of Apple, right? If you go to Walmart, if you go to Target, if you go to Amazon, you're going to see this brand name pop up everywhere. You're going to hear your friends talking about, oh, I bought X, Y, and Z with Affirm, and it's really going to appeal to more and more people. So partnerships is a huge, huge part of any business, but super big in the payment industry, because it's all about bringing that attention to consumers. And as a first mover, them and Klarna is another competitor, but as a first mover, their name is synonymous with buy now, pay later. You see Affirm, you know that that's what's going on. And Once users are on the network, think of it like a bank, right? If you bank with Wells Fargo, how often are you going to change your bank, right? It's just tedious. There's really not much difference between checking accounts. Savings are one thing because of the interest rates, but you're not going to do that often. So if the more people see the name, that sticking cost is going to grow. And it's just going to create this positive feedback loop, just really growing the propensity for people to want to keep using the service because they see it, they use it, they know what they have. Excuse me. And this was something that I found out recently, that like even your phone bill can be used to with Affirm, which again, people's phone bills, people's internets, even in times of crisis, in times where goods are going through the roof, phone and internet is one of the last things to go. You lose your job, you need internet to even apply to other jobs. And so that is really speaking volumes to how ingrained Affirm can really become in the consumer household. To that note, these are their major products, okay? This is how they get ingrained. Number one, they have an adaptive checkout, which offers personalized payment options to online shoppers based on their selection. So it'll see what you bought, how much you bought for, and in the real time, it'll tell you what you are pre-approved for based on the different payment plans available. Now, what are the different payment plans available? They do have interest-free loans where they have pay in 4 or pay in 2, which allows you to split the cost of the purchase over to 4 payments or 2 payments, or pay in 30, which you can pay in 30 days. These are interest-free loans. What this means is, remember I said they can either make the money off the interest or they can make money off of, again, they called it gross GMV, gross merchandise value, the money going through the network. So the consumer doesn't see that. And the consumer sees, hey, if I'm buying $200 worth of goods, that's $50 every 2 weeks, no interest, I still pay $400. That works for the consumer. The consumer should take that. It is free money in the sense of a loan that is being given to you if you can't afford it immediately, and you're not paying any extra interest to use it, and Affirm will make their money behind the scenes without the consumer knowing. Now, they do have other forms of loans, which I spoke about earlier, similar to 32 payments of $32. If you do the math when you see that, it will come out to be more than if you did like a pay in 4 or a buy now, right? That is monthly installment payments greater than the term of their interest-free loans. And by that, I just mean the longer your loan period is, the more likely you are to pay interest and more interest on top of that. They typically will not tell you that you are paying interest. They will bake it into the loan. So I'm buying $500 dog crate. If I want to spread that out over 2 years, so 24 months, that is not a pay in 4, that is not a pay in 2, and it's not a pay in 30. What they will do is they will say, hey, you can pay $20 a month for 24 months. No, that's too cheap. You can pay, let's do $40 a month. You can pay $40 a month for 24 months. I still don't think that's whatever. $40 a month for 24 months, and you'll have that dog crate, right? But if you take the time to realize that payment is going to be greater than the $500 upfront cost, and so that APR is baked into the loan itself. So they're not charging you interest; they're just lending you money, where you then pay them more back for lending you money. It's again two sides of the same coin. It's really who's using the loan, do they understand what they're doing, and everything that goes into it. Number 3 is the Affirm card, right? This is critical. This is a credit card. Again, this is where they change the game. Credit cards do exist, but Affirm uses their own payment network. They're not using Visa yet, VisaNet. They're not using MasterCard. This is the Affirm card on Affirm's network, which you can use online or in the store with Apple Pay or a physical card. And it operates like a regular debit card. I'm sorry, this is not credit. This is debit. They are lending you the money to spend. So in a sense, it is credit, but it is not a credit card. It is not a line of credit that you keep spending. It is, hey, we're lending you $500. We're going to fill that card with $500. You then have to just pay us back the $500 no interest if you paid in full. So it is an evolution per se. It is short-term debit that is a longer-term credit. And it allows consumers to convert debit transactions into installment payments within 24 hours. The card is connected to the user's bank account. Again, this, if you don't have enough money in your bank account, they will subsidize the rest. If you only have 300, whatever it may be, they are working with you. And number 4, this is the most critical, in my opinion. The Affirm Money Account. The Affirm Money Account is a savings account through Affirm that pays over 4% interest and has no minimum balance or fees and is FDIC insured. What this means is that Affirm is offering a high yield savings account. Now, why does this matter? It will bank the unbanked. Take a step back for a second and think about that. It will bank the unbanked. We'll see later on, literally in the next section, what the customer mix looks like. But typically for these short-term consumer loans, you have people with great credit, bad credit, and then probably about 50% that it's not the best credit. They'll probably be using Affirm because they can't really afford the goods, or they want to pay for other goods, and this is a means for them to do that. Those consumers with those credit scores may not have experience with banking. They might not know the difference between a checking and a savings account. They might not know what it means to earn a yield when your money is sitting in a savings account. And so by Affirm offering these consumers, let's say they go to Walmart and they're like, oh, I know Affirm. I use Affirm to check out at Walmart. Oh, look, Affirm is offering me nearly 4.5% if I just put my money in Affirm. And I use Affirm every day when I go to Walmart. Okay, why would I not do that? And again, Affirm their interface is super easy to understand. They will even show you what it looks like to grow. If you just put $500 in their account, it'll show these people visually what it looks like. And so they're providing a banking service, right? The savings account. They are providing a card to buy goods, and then they are providing the loans. This is a fintech. This is shadow banking in a sense. This is banking the unbanked. And again, to our prior point, think about a Wells Fargo, think about a Bank of America. When you have a banking partner or you use a bank, you are less likely to switch from that bank, either the sum of money or whatever that bank may have. So scroll down here. This is what I was talking about. This isn't the savings account, but this is what they're showing you what that payment looks like. They're going to do the same for the savings account, and they will never charge you the late fees. The APR, as we said, is baked in the loan. So all of this is coming together and allowing these consumers to do everything from one place, and it is super user-friendly. This is what the card looks like. Again, super standard card. You can add it to your Apple Wallet, and the app is super friendly to use. So, customers. What does the customer mix look like for Affirm? They have 18 million active users, which we knew. They have $293 in average order value, and then they have $663 outstanding balance per user. So people are spending nearly $300 to buy goods every time they buy goods. And then these users have double that outstanding on their Affirm balance. So they will continue to come back and spend goods and have to pay off those loans with Affirm. And it is just a constant feedback loop of loan, payoff, loan, payoff. So they do have $12 billion in outstanding balances, which results in a large accounts receivable balance. That just means that is goods, or that is revenue that they have, but they have not received. And so that is concerning a little bit. But while the payment of the collection of this AR balance and the payoff of these loans means a lot for. They have $12 billion in outstanding balances. This top circle, I'm pointing to it, this top circle, which results in a large accounts receivable balance. But that $12 billion in outstanding balances is not pure profit for the company. It just means that they have a large outstanding debt. And so their active consumers increased nearly 20% year over year. And that is just huge growth for a company that is only 12 years old and in their 12th year. This is the customer mix that we were talking to earlier. Nearly 50% of consumers, 48% are super prime and prime. These are your people that typically you don't have to worry about paying their loans back. Above 660 credit score, you can even go a little bit lower to roughly 75% of near prime, which is all the way down to 620 credit score. Your your subprime and your deep prime are your least likely to pay back the loans, the lower credit scores. And then you do have some people developing credit, maybe they're 16, 18, whatever. This is something to keep an eye on, but it is super important when thinking about Affirm because you don't want people taking out loans that are not going to be able to pay back those loans. So as we said, nearly 50% of the customer base resides in this super prime area, which is super good. If you're an investor in Affirm, it means they're the most likely to pay back their loans. And that other 50% is going to provide you probably a bigger yield on the money. So while the subprime and the deep prime may not pay back all the time, or they may not have the means to take out larger loans, they typically, and this is why their credit score is where it is, do not take the options to pay immediately or pay in full, garnering more revenue for a firm because they are going to have to take the loan options with the larger APR baked in. So a staggering result is to see that a lot of customers have high credit scores. I was super shocked when I saw that. I did not think a lot of customers would have that. And whether this is indicative of consumerism or rising living costs, many first-time users who are able to pay off these loans will more than likely resort to using it again once they see how easy it is. Something to note, if they do not pay off the loan, after 120 days, Affirm offloads delinquent loans to third-party collectors, which will then send them to a collections agency. And so if we assume that the subprime, deep prime, and developing credit are the most likely to default, we really want to keep an eye on what percentage of that 29% cannot repay their loans. That is substantial because when a third-party creditor or collector buys these loans from Affirm, they're buying them at a discount because they will make the money on the total value. So it is this shiftiness of Affirm is going to have to take a discount on the total loan amount, which means less revenue, which means, they took a loss. So that is something to keep in mind. We'll see later on, they do subsidize a lot of this with debt. So annual income by consumer or by customer, again, something super similar to the FICO scores where, what is that, 48%? Make above 60 grand a year. Again, super concerning that more than 50% make below 60 grand a year, which kind of plays into the FICO score. But again, credit score has nothing to do with how much consumers earn. I will say that those that make below the 60,000 threshold are more likely, based on this, to use Affirm, which will extend those short-term credit loans per account or active customer. So it is incredible to see that 1/5 of the customers have a 6-digit income. That was super incredible. I did not think that would be the case. I don't know if that's because they want to use short-term credit, especially if it's, again, free money with no interest, but or if it's indicative of larger macro and micro trends of how they're spending their money. But it definitely causes us to track this and what is the default rate that is going on within Affirm. Default rate simply meaning who is not likely to pay those loans back. Okay, so this is the market. This is what Affirm is competing in. Expected growth rate of 20%. Compound annual growth rate, as we saw, they did grow nearly 20% of users within the last year. But again, this compound annual growth rate, I believe, is into 2028 or maybe even 2034. So that is huge to keep growing like that. Largest market is North America. The fastest growing market is Asia Pacific. And so they need to really break into that international there. The largest market share by segment is the large enterprise, as we saw. Amazon, Target, Best Buy, really allowing their customers to purchase their goods. But the fastest growing market share by segment is going to be your small to medium, because once there becomes a demand for small businesses to accept Affirm or to even take out loans themselves, they're going to want to bring that on board. And then lastly, the largest channel is e-commerce, which again, we've seen, if you have an Amazon account, go to Amazon checkout and you will see that the Affirm option is there. So just high level, the buy now, pay later market is a huge competitive landscape. There are new fintechs every day that are adding this or even starting up just to compete in the buy now, pay later, which is going to increase the competition. Again, we have Klarna, we have Affirm, we have PayPal, Synchrony, all these different buy now, pay later companies are competing. But something that was cool was that the U.S. Federal Reserve suggests that the current credit card utilization rate stands at around 21%, meaning if you have a $10,000 credit line on your credit card, most people are only using 2,100 of that. They're not using their entire credit line, which is more indicative that people want to cut. They don't use their whole credit line, so why would they not become more specialized in when they take those loans out? And thus, they don't want to be entirely over leveraged or have this credit to their name. So they might be more likely to utilize this buy now, pay later instead of having that large outstanding credit line. Driving growth, rising numbers of e-commerce platforms with online payment methods is accelerating market growth. And then what is hindering growth is the lack of awareness. Again, that is something that we talked about, getting the name out there. As long as the Affirm symbol is out there, that is huge. As long as their logo is out there, that is huge. And understanding what goes into this with all these different payment options available, credit cards, checks, debit cards, crypto, whatever it is, knowing that buy now, pay later, BNPL is an option is huge for the customers to onboard. All right, so I know that was a spitfire session right there. We went really fast. That is already at 51 minutes. And so lastly, this is all the financials. I'm going to go through pretty quick because I do believe that the financials, while they are important, they don't speak to the moat that a firm may have in a competitive landscape. But GMV was the gross merchandise volume. This is the total volume of money used on the network, which is $7.2 billion. I believe if we go up here, did I put it in here? I did not. The total, you might have to take my word for this. The total, it's right here actually. With the global market value of BNPL surging to over $150 billion in 2032, recent estimates indicate that U.S. customer credit limits could jump nearly 50% to 1.27 trillion. Again, this is what we're talking about. If they have a credit limit, they're only using 20% of that. And so this forecast suggests that by 2032, the buy now, pay later market will be worth $150. The 2024 projection, which is right now, is roughly 40 billion. What does this say? 7 billion of the 40 billion, almost a fourth, is through Affirm. And there are hundreds of buy now, pay laters in the world. That is a staggering amount that Affirm has captured. So there appears to be a growing battle between existing payment platforms, PayPal, banks like US Bank, as we said, and then other fintechs, Affirm and Klarna, trying to compete in this buy now, pay later space, because this will be a huge battleground for payments. So again, their product suite plays a huge role in getting customers on board and taking them away from incumbents by banking the unbanked. That is the most important here. That is a narrative you'll hear in crypto. You want to bank the unbanked, provide a service that helps the customer while also running your business. So back to the financials. GMV grew 31% year over year. Their active merchants, which we knew, 19%, alongside active consumers. So more merchants, more consumers, self-reinforcing loop. The more people that use it, the more merchants will have to use it and accept that payments. Revenue less transaction costs. So this is the total revenue minus everything it takes, just to run the network. Now, here's something that is very important. They do operate at a negative margin. So they are technically losing money. Their operating income in quarter four was negative 73 million. But that is a gain. They gained 170 million in the quarter. They are becoming net positive. Again, same thing with the net income, 45 million. 78% year over year. That is a $161 million gain. Do the quick math. You can see that they were in the hole over $200 million last quarter. And so this is just a description of what GMV is, the total value of merchandise that is sold over the network in a given period. And these are just some other network drivers. Network revenue, again, this is that fee that they're charging for using the network, grew 28%. Interest income, longer term loans, grew 57%. And then the gain on the sales of loans grew 116%. This is something they do that is super, super, super important. Affirm packages the loans and sells them for yield to banks. Now, why is this important? Because this is a little bit of a flag. In the 2008 housing crisis, the banks packaged mortgages and sold them to institutional clients to invest because they packaged high-end consumer loans, your AAA, your AA, these are your most likely to pay back. They packaged them with shit credit. Your double Bs, even your Cs. And this is really where the rating agencies came to play because someone has to give a rating, AAA, AA, to these securities, asset-backed securities. In the course of the 2008 housing crisis, they were MBS, mortgage-backed securities. And so it is a very, very slippery slope. It is a similar vein. So we do have to hope that the rating agencies are on top of their shit and that Affirm is not bundling these in a way to hide bad loans. And so that is simply why I said we need to see what these loans are doing. But this does help Affirm because number one, they're offloading that risk. They are packaging these loans and selling them. And while they may not be getting all the interest from the loan itself, let's say the loan is going to make them 30%, they may offer 20% on the securitized product. So they are then getting money up front from these institutional investors and then keeping also 10% for themselves. So that is a huge, huge revenue generator for the company. 116% it grew. Again, these are other notable factors. I know we're going pretty fast here. We're already at 9:15. I'm just trying to keep ahead of time. They did increase the sale of loans, which we just talked about. The increase in servicing income, which was small, but it is huge. Servicing is the process of collecting payments on a loan and passing along the distributions to the parties involved. Because Affirm is issuing loans, they do not charge interest on missed payments, and servicing income will likely remain low in the future. They do have an increase in operating income, which we saw above. It is negative, but it is up 170 million. Of the 73 million, negative 114 million was attributable to share-based expenses paying out. Again, they are growing. They have to get money in somehow, and this is by share-based expenses, such as warrants to enterprise partners. Essentially, they have sold equity to institutional partners so that they could have cash money up front. So they sold part of them so they could have money to run the business. And 65 million to employees based on stock-based compensation. Again, this is similar to the adjusted operating income. And then lastly, the increase in net income, we know it's up from negative 206 million. It's up 161 million. It still remains negative. But this is primarily driven by the 127 million of revenue less, transaction costs. And some of that is also based to stock-based expenses. So as the company matures, I think how we can summarize this is as the company matures, they will continue to pay off stock-based compensation, stock-based expenses. Now, it does still exist in the future. You have employee stock purchase programs. You have RSUs, restricted stock units. But when you're a startup, especially as big as Affirm has become with the people that have begun it, they know how to raise money to start this. And they know that you need a lot of capital up front to start these firms. So what do? They take on debt. They essentially say, hey, give me some money. You'll get share in the company, but we need money to get this going because Max probably did not want to front all the money necessary to grow this company as fast as it has grown. So with that being said, over time, they will continue to pay back these companies, which will lessen the future payments and will then help them become cash flow positive in the future, hopefully in 2025. And that is a sticking point that Max has said that they are hopefully going to become net positive their income will be positive in 2025, and we will definitely have to come back and check that out next year. So here's some graphs for your eyes. Revenue and revenue less transaction costs. This is the growth from year over year. So fiscal year 2023 quarter 4 to 2024 quarter 4. Interest income has grown, so has other revenue. Network revenue has dropped minutely. And then these are all percentages of GMVs. Those are not as important, but they are still relevant to look at. But what I do think is super important is the credit lines. Year-over-year comparison of monthly installment loan, ex Peloton, because they did have loans for Peloton, and the 30-day delinquency rate. So if we look at this, these are the delinquencies of 30-day loans. Sorry, yes, we said that, but excluding pay in 4 as well, has slightly increased year over year against the prior quarter. Our fiscal year 24 is this light blue line, right? Unless we zoom in 100%, you can't even see that it's a lot more. So it's on line with what it has been. So that delinquency rate is around 2.5%. But it is expected to trend historically. And while we would like for them to not have any delinquency rates to capture all that money, we do know in the business of loans that does not occur. Some people will default. Some people will be unable to pay back loans due to market circumstances, due to personal circumstances, health, you name it. And so it is good that they are keeping it close to the historical average so that as an investor, you know what to expect and that these are relatively low. Conversely, the cumulative net charge-offs by origination, the net charge-off again is them selling it to the third-party vendor. Again, really, really low, around 3%. And if we look at the Q4 23, it is a little bit higher than most. I do not see Q4 on here, but if we look at Q1 and Q2, they are lower. And so they're becoming a lot better. And this is something that we need to discuss. As time goes on and the more data they collect, they will be better to accurately predict with their algorithm how much they can loan to consumers, which in turn, better loans means less charge-offs and less delinquencies, which in turn would mean more money for Affirm. So this is all hypothetical, but you would assume with the more data they collect and the better they get at what they do, they are going to be giving less loans to people that don't deserve them, which saves money in the long run. And then this is the cumulative net charge-offs by pay in 4 loans. The pay in 4 loans were the ones that do not have interest on them. It's bi-weekly, and we can see here January and February of 2024, as well as the quarters, are the lowest that they have ever been. And this goes to a testament of over time, they will get better and better at what they do. Okay. Capital and funding. As we stated, Affirm packages their consumer loans as a part of Affirm asset securitization, which takes these asset-backed securities, the assets are the consumer loans, packages them, and then sells them to investors. Now, one thing to know about these loans is that the asset, although the securities to the institutions, so let's say we have 10 loans that Affirm has given to me, they'll put them all and say Brandon loans, and they will, Pear loans, they'll take them all, Pear loans, and give it to Morgan Stanley, and Morgan Stanley will buy it, right? So those are all 10 loans, my loans on me. So the security that they just sold Morgan Stanley, that is asset backed. That is backed by my loans. However, the loans that are in that security are unsecured. They are not asset backed. They are only based on my credit worthiness. I have not given anything to Affirm to say, hey, if I don't pay my loan, you're not getting anything. So that is one thing to note if you're an institutional investor too, is that although these securities are asset backed, they are unsecured and they are pooled together based on ratings. Again, this goes back to 2008 and the rating agencies. Will they rate them correctly? But as one of the standard Rating agencies reports the average credit on these loans is 679. That is an average. It's not a median. It is an average, as well as we don't know what else is in there. So that is a caveat and something we need to also keep an eye on. As of 2024, there was 3.4 billion of asset-backed security issuances that Affirm has out there. So this is just what we were talking about with the similarities to '08. Now that can be scary, but don't let it scare you away. As we come to the end here, these are some important tidbits of the financials. As of 2024, there was 2.1 billion in total liquidity split between cash and securities available for sale. That is short-term cash, so readily available for them to use, expend, pay off debt. Conversely, they also held 1.3 billion in convertible debt as of the same date. At the end of 2023, the board of directors authorized the repurchase of up to 800 million in principal amount of their outstanding convertible debt during calendar year 2024. So the reason I skipped this before telling you what convertible debt is, let's say they issued bonds. Hey, we need $100 and we'll give you 5% on the bond. And so just like a federal bond or a state government bond, you give them $100, you hold their bond and they will pay you, 5% over the lifetime of the bond. What a convertible bond is, convertible debt, it allows you to convert that bond into shares of the company. Okay? So why does this matter? Typically, convertible debt has a set conversion price, so what you can convert it at, or a time period when you can convert it. And it also makes the investor think about priority, right? So convert debt on the scale of things, bonds, notes. If this company were to go under, they would get the money back first from whatever is salvageable. Common stockholders are last. That would be you and me. So debt would come first, but also this company does not pay a dividend yield. So outside of the stock price increasing, those investors, you and I, do not gain anything. We do not get cash. We simply are investing because we think the company will be worth more in the future, or that maybe they'll have a dividend in the future. So if you're an investor in the debt, you may not want to convert it to securities. It's entirely up to you and what the terms of the note are. But if you are Affirm, you do want to pay them back, because if more and more people decide to convert those bonds, it does dilute the outstanding shares, which can become an issue for ownership and other things. So that is why they're repurchasing a lot of this convertible debt. They don't want that out there, and they did convert a lot over 2024. And it looks like at lower rates. So they did gain on these bonds. The bonds probably were not trading as high as when they were bought, and they bought them back. So Affirm has a total gain of 333 million in 2024, with 582 million of available convertible debt left to be repurchased. So remember, they started at 1.3 billion, and they have since cut it down to 500. That is astounding. And to do that, they either could use cash or what have you. Again, we did not research all of their financial documents. We did the high level stuff, and that is really, really great to see. And so on a separate note, the funding capacity has increased 500 million, which could be how they paid this down over the previous quarter to 16 billion. And this gain is largely due to an expansion in the relationship with CPP Investments, which is one of the largest pension funds in the world, is the Canadian pension fund of 1.4 billion. So they took out a line of credit with them. They lent them money, again, taking priority, but also this is a way for a $463 billion investment fund to invest in different areas and get a gain on their investments for their shareholders. So getting to the end here, yearly financials, the income statement. We're gonna kind of breeze through this because we are getting tough on time. We are at an hour and 10. On the income statement, revenue you see going up, interest revenue, total revenue. Operating income has decreased. This is stuff that we have covered up above, but just to see it visually, the EBITDA, earnings before interest, taxes, depreciation, amortization, That's basically like, hey, how are we operating on a business scale without all these other bullshit fees? Uncle Sam, whatever. That's what EBITDA is. So they did decrease, but they are coming back in the last year, and we'll have to keep an eye on that 2025. Again, we will be revisiting this to see if they are cash positive. The expenses, another key part of this is the cost of goods sold has gone up. That is probably the cost to keep the network active. Their SAG expenses, selling, general, and administration. Everything else, you're paying HR, paying other functions that don't contribute to the actual sale of their products. And then R&D. They are spending millions in R&D, which probably has a lot to do with stablecoins, crypto, which, again, later on, we will not be going through all of that currently. Things to know: Affirm has methods in which they raise capital. I believe the main thing necessary to focus on is they're raising the net income, because if they raise the net income, their earnings per share increases, and then they, again, positive feedback loop. Greater net income, more earnings per share. That's how we got there. As previously discussed, Affirm's products generate a self-reinforcing loop. Affirm Money Count pays off the card, which the card then is used to use at the checkout. So feedback loop, positive cycle. As more customers join the network and use the product suite, revenues will increase. With increasing revenues, hopefully at a faster pace than the expenses increase, Affirm will generate a positive EPS and thus finally be able to give some money back to shareholders, whether through stock buyback programs or dividends. And then lastly, this is their balance sheet. Their assets have increased. The total cash, short-term investments, total accounts receivables slowly increasing again. We don't want that to balloon too high. And then their total current assets. We can go through all this, but it's really just to show you guys how everything is moving along. Current liabilities have also grown a little bit. Total liabilities here is this blue line. You can see it's almost at like 6-7 billion. Right here, 6.5 billion in long-term debt. Again, this also goes back to the extended credit lines that they have from like the Canadian Pension Fund, from issuing these asset-backed securities. There's a lot of different reasons they have this outstanding debt. And so what I'm really hoping is that they can pay this down over time. Like right here, they have 1.8 billion of the long-term debt in revolving credit. And so a lot of this is to keep operations sound and to keep growing at an astronomical pace. But we do need to keep an eye on it, because if Affirm's consumers stop paying back loans, that will impact Affirm's abilities to pay back loans, which then will impact you and I. So one thing to keep an eye on in the future is that. And then lastly, cash flow. We did talk about this briefly. Cash flow from operations was negative. It is positive. Okay. That is huge, because now everything that they do from their standard products is generating positive cash. Their cash from investing is negative, but it is slowly growing. And then their cash from financing, again, we do know they have revolving credits and other lines of getting cash. So the net change in cash is back to above positive. It does fluctuate year to year, but it is something that, again, we do need to keep an eye on. Other notable things is that they do have a high depreciation and amortization cost in 2024, which I get that, but you don't want that to be a large source of where their cash is coming from. They did have almost 200 million in loss from sale of assets. So this could be the loans. This could be companies. It could be them selling returnly. We don't know. I did not research that. I want to say that out there. Again, this is not investment advice. I'm not a financial advisor, but this is what I've seen from researching the company. Other operating activities, they did get 181 million, and they did see a net decrease in loans sold. So they did lose $1 billion there. The long-term debt issued is close to 14 billion. And so it seems to be that a common theme here, especially in the latter half of this report card, is the biggest question that I'm seeing is they do carry a lot of debt. Now, if they're a growth company, which they are, that makes sense. You need money to grow money. So we will need to keep an eye on this. If a firm can manage to operate in an efficient manner where they are paying off this debt and increasing the income that they generate and the revenue they generate, I don't see why they can't pay that off in the future and use this revolving credit to continue to grow the company. But it is something that we need to keep an eye on, and I would love to see them grow their short-term cash and short-term investments, because then if they're sitting on a mound, think of like your Berkshire Hathaways, if they are sitting on a mound of cash, they can compete more efficiently and buy up their competition. You can do that with levered buyouts, but LBOs have not really been a thing since the 70s and 80s, and I don't want to see them take on more debt, right? They are debt heavy. So unfortunately, we are at time. It is 9:30. The conclusion we did not get to write, but I will put this out there if anyone wants to see it, and I will have a conclusion written up. And I did have every document that I used, the documents I put together, as well as the documents from Affirm. And there are other documents out there that I did not get to add into here. So with all that being said, key people for Affirm as we go through this report card: outstanding, super green. The product market fit, super green, right? It is the next phase in the evolution of the consumer credit cycle. Their partnerships are like 11 out of 10. They have the biggest online stores. They're in brick and mortar stores. They're on your phones, and they are able, if you are even able, I did not research this, but to even pay utilities with Affirm. It is going to be so ingrained in the way that consumers operate their lives. Their products, again, super green, positive feedback loop. Use the Affirm money account or the cash account to pay off the credit card, to then use to buy goods, and then the goods. And so you're like, okay, I'm already using this. Let me put more money into the cash account. And it just feeds back into itself. People talk, other people see, oh, how are you able to buy this? And it all comes together. A yellow note here is that the buy now, pay later market, the BNPL market, is huge. There are large incumbents like PayPal, but that is where our boy Max comes in. He does know PayPal and how they operate very well and where their downfalls may be. They also do have a huge first mover advantage. Think about your Bank of America, how fast Visa grew, being the first one to be able to do that. Capital and funding, large amount of unsecured asset-backed securities issued. And so while this does provide a means for them to get cash and get their name out there to investors, we do also have to keep in mind the asset-backed securities that are being tied, or the loans being tied to these asset-backed securities. The debt load, this is the one thing that I want to harp on the most. They do have a lot of debt. I do not like that, but I understand that you need debt to grow. And so they are heavily subsidized by debt, and this debt is prioritized over the short or the long term, especially over common stockholders like you and I. The financial statements, debt poses a huge flag throughout again, but the repackaging of consumer loans, offloading that risk, getting revolving lines of credit, and being able to see the credit scores within these asset-backed securities of about 650, and being able to, again, over the long term, provide accurate short-term consumer loans, I think will be a huge testament to not only their products, but impact on their financial statements, because it will reduce the risk of default. And then lastly, the future outlook. The service will continue to grow and become net income positive. Max has stated that in 2025, they will become net income positive. I hope that to be true. I truly, truly do. We will have to keep an eye on that. But on the flip, higher consumerism and living costs will push the need for companies like this into consumers' hands. Again, self-reinforcing, it is a positive feedback loop. So this is not investment advice, and I would like you all to know that I do have a vested interest in this company. Going through this research, I did purchase shares in this company. As we saw at the beginning, since my time of purchase, they are up over 30%. Again, not investment advice. This is not telling you to go buy the stock. This is simply to show you what companies are out there, what they can do, and to learn more about how our world works, especially from a finance side, because it can be a bit tricky if you don't know the risks involved. So please do take precaution. when investing. Not every investment's going to be great. This might go south in the next few months. A lot of the market is up because of the election recently. So do your own due diligence, do your research. But if you would like to use this as a starting point, or any of my videos, please do so. That is why I'm doing these. And feel free to leave comments on any of these videos if you have any questions, or reach out. And I really do hope that this had an impact on you, because I enjoy doing this and learn a lot about these companies. In fact, I'm not going to lie. Again, the furniture story that I told is true. We did go to buy furniture, and it wasn't, it did help because they use Synchrony at Citi. Who's the other one? Rooms to Go, Synchrony. These big purchases use Synchrony to finance. And it isn't until you realize how Affirm works that Synchrony operates in a similar manner. And so you are able to deduce what is a good deal on these loans that you're taking out, how you're able to buy these assets. And you can really, I know they're salesmen and they're on the floor, wherever you may go, but you can really kind of have that pushback of how these loans work and what you're comfortable with in your own lives. I really hope you enjoyed this stream. This was a culmination of the last 3 weeks of putting this all together. We didn't go through the deep financial stuff, so please take a look at that if you are not sold or you are skeptical. We did not go through that. That is not as fun. Even this finance stuff is not fun to watch or even go through. But it is very important to know how the company operates, what they do, and what competitive advantage they may have on their partners or on other people in the landscape. But it is also super important to understand their spending habits, what they're spending on, how they're hiring, and the like. So definitely keep up with earnings calls. Definitely keep up with what's going on in the market. And I sincerely appreciate you joining throughout this. And we'll be back on Monday, bright and early. We'll be doing our newest Pear Does. Stay tuned to figure out what that is. Deuces. Do it again.